Navitas Semiconductor is up about 145% year to date. So is Navitas stock still going to go up, or is this the top? Well, here's what I know. Nvidia picked Navitas to help move AI data centers to 800-volt DC power, which is a massive foot in the door moment. At the same time, revenue just fell 53% year over year to $10.1 million, and they're guiding next quarter at just $7 million. It's not a typo. Sales are shrinking while the story is getting louder. Not only that, they just raised about $100 million by selling 14.8 million shares at $6.75 each. Dilution? I don't hear anyone talking about that. So, do the data center design-ins turn into repeat orders, or does the cash burn run out before another raise? Well, in this video, I'm going to break down what's real, what's the hype, and what has to happen for this to be a legitimate long-term winner. Now, if you're new to the channel, hey, what's up? I'm Rick Orford. I've been trading since 1999, and no, I'm not a financial advisor. That is a good thing. I break down the numbers to help retail investors like us make smarter, more confident decisions with our money. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/RickO to get your 10 stock picks right now. Navitas is a pure power semiconductor company that makes gallium nitride and silicon carbide, or GaN and SiC-based technologies. These technologies are used to charge a wide range of products, including electric vehicles, mobile phones, industrial machinery, and even data centers. Yes, that is where the real money is flowing right now. And Navitas got its foot in the door in a big way when Nvidia chose Navitas to help it transition to 800-volt direct current, or VDC, architecture for data centers. But does partnered with Nvidia mean durable demand, or just a very pretty press release? Well, if you're unfamiliar, traditional data centers run on 54-volt in-rack power distribution. And this was perfectly fine for regular servers before, but of course AI data centers now require tremendous amounts of power. And this means Nvidia's shift to 800-volt DC allows for far greater power efficiency, reduced energy loss, and better scalability. And this is all possible because Navitas's next-generation GaN and SiC power solutions can handle higher voltages with significantly less heat and energy waste, while having a lower physical footprint than traditional silicon-based power systems. It's kind of like upgrading from a narrow garden hose to a high-pressure line, so you move more power with less waste, less heat, and less bulky hardware to get in the way. Now, if this 800-volt move actually becomes the standard, the upside is just incredible. But if it doesn't, you're going to see it in the numbers first, and that's what we're going to talk about. On November 27th, Navitas Semiconductor announced a strengthened partnership with WT Microelectronics as the company streamlines its Asian distribution network. Navitas has consolidated its distributor base, while WT is expanding its technical and commercial resources to support customers across AI data centers, high-performance computing, energy infrastructure, and of course, industrial electrification. Now, under the new structure, WT will take the lead on customer engagement, design-in support, and regional logistics, helping ensure faster delivery, improved supply chain reliability, and stronger adoption of Navitas's GaN and SiC power devices all across Asia. And why does this matter? Because in semiconductor land, design-in is how you get locked into future revenue, and distribution cleanups can quietly set us up for a next upcycle. Also on November 7th, Navitas announced a private placement that'll bring in about $100 million through the sale of roughly 14.8 million shares at $6.75 each. Now, this fresh capital will now support working capital needs and help advance the company's Navitas 2.0 strategy, which is basically their pivot plan for where future revenue is supposed to come from. But cash raises come with a trade-off, and we'll talk about that, what that really signals in a second. For now, let's have a look at the numbers. Navitas delivered a very tough third quarter. Revenue dropped 53% year over year to $10.1 million and fell another 30% from the last quarter. Operating loss was $19.4 million for the quarter alone. That sounds bad, but it's actually better than $29 million loss from the same quarter last year. What's going on? Well, the company is doing what they call, well, as I just said, Navitas 2.0. Basically, Navitas is wanting to shift away from consumer and mobile markets, especially in China, and moving towards higher power applications, the more expensive stuff. They're now targeting AI data centers and performance computing. Basically, they're walking away from the lower margins to go after markets they think will be far more profitable long term. This basically explains why revenue is falling so hard. The company is pressing the reset button on their business model. And when you look ahead, management is guiding fourth quarter revenue to come in to just about $7 million. That's another drop as they continue to exit the China mobile and consumer business, and while they clean up their distribution network. So the setup here is simple. The chart looks strong, but the fundamentals are still mid-pivot, right? And pivots are where investors either get paid early or get punished early. So what do we have to be excited about? Well, this is something that's come up in my Discord channel recently, so let's talk about it. Now, Navitas has been earning less this year compared to last year, but there's several factors that could drive its growth in the coming years. Their GaN chips do more than improve performance for end users. They also helped cut the environmental strain from data centers, which are projected to see their electricity demand increase by as much as 300% over the next decade. And while AI companies are going nuclear to address the problem, it still doesn't solve water consumption. Data centers consume a lot of water, with larger ones estimated to use up to 5 million gallons a day. With Navitas' technology, data centers and other mass-scale computational facilities can achieve higher power efficiency, which in turn reduces their electricity and water consumption. Plus, of course, it reduces their overall carbon footprint. For companies, I say it's a double win. It lowers costs and it strengthens their ESG scores. And when you improve efficiency and sustainability all at one time, you're no longer just selling chips, you're selling reputation. Of course, the government is also continuing its National Electric Vehicle Infrastructure Program. This program is part of the Infrastructure Investment and Jobs Act that allocated $5 billion to create a national network of EV chargers. The $5 billion is split among individual states based on a formula, and each state then builds EV chargers at their own discretion. So why am I talking about this bill? Well, Navitas could gain here on two fronts. One, its GaN technology could be used to make EV chargers. Two, if EV chargers are more accessible, it could drive up EV sales. And while Navitas is not an EV company, many of its clients actually are. In fact, Navitas' technology is used in EV products from batteries, converters, and traction drives. And this is where the bull case starts to sound persuasive. But the bear case shows up when you look at what's happening right now. Of course, not everything is smooth sailing for Navitas. There are some risks. There's a lot of risks involved by owning the stock. And it's where most retail investors tend to get blindsided. To me, the biggest red flag about the company is declining revenue. I mean, here's a quick look at the company's sales in the last 5 quarters. And while their operating expenses are decreasing, net income is also decreasing, which is never a good sign. While Navitas has discussed their pivot to AI power infrastructure, and of course the tariffs that they have to pay for importing goods from China, their expectations for Q4 are still very weak. The outlook suggests that management is tempering expectations despite the AI narrative. Why? Because when guidance stays soft, it usually means this demand hasn't snapped back yet, or they're still working through channel inventory and customer timing. As it stands, I'd like to see better signs of revenue stabilization. I want to see a clear path for it going up before I mark this risk from my analysis. Also, don't forget the ongoing trade tensions with China. This is a big risk. China is a major electronics market, and higher tariffs on Chinese products could raise costs for devices that use Navitas's chips, which could weaken demand. Not only that, Navitas has exposure to the Chinese EV market through Chang'an Automobile. The Chinese automaker uses Navitas's GaNSafe technology for onboard chargers. If tariffs escalate or restrictions tighten, Navitas could face a triple hit: weaker consumer electronics demand, slower adoption in electric vehicles, and of course, supply chain issues. Navitas is also taking a hit from the removal of tax credits from the solar and EV industry. And with the removal of tax credits, demands from EV and solar manufacturers may slump, and consumers may just be less willing to buy solar and EV products. This unwillingness to buy EVs and solar could have a ripple effect on Navitas's profitability. So the risk isn't just one headline, it's multiple pressure points all stacking at once. But let's see what's actually pricing the stock in right now. Last time I talked about Navitas, the stock was trading at around $8. Since then, the stock has gone up 12% and is now trading at around $9 where it is today. Year to date, the stock is up around 145% and up 255% in the last 52 weeks. That's a monster move, which means expectations are already high. So the big question now becomes, is now the right time to buy Navitas? I mean, remember, the stock is generally up this year. But does that mean it has room to go higher, or is this where the ride stops? Well, consider that a consensus among 9 analysts currently rate Navitas a hold, down from a moderate buy just 3 months ago. And the rating comes with a high target price of $13. So that suggests as much as 44% upside from the stock's latest closing price. However, the average score has gone down from 3.44 to 3.22. This time, I tend to agree with the analysts. Navitas is pivoting to a whole new product line. But don't get me wrong, the company just tightened its Asian distribution network through deeper partnership with WT, giving it stronger technical support and faster logistics across key high-power markets. On top of that, Navitas has the funds from a private placement that'll help fuel its shift into AI data centers, which will advance computing and energy infrastructure. And these moves could signal a real turning point, but only if they can execute well. And that execution is going to show up in 2 places: revenue stabilization and real design wins that convert into shipments. But what about you? Do you think these moves are enough to spark a real turnaround of Navitas, or is it just a temporary lift? Let me know in the comments below. And while you're there, if you found the video helpful, don't forget to like and subscribe, because it helps others find the video and it supports the channel, and you won't miss out on my future deep dives. Well, that's it for me today. I want to thank you so much for watching, and I'll see you next time.